Okay, welcome to day 3 of our elective. I'm excited to introduce two awesome members of the CMA staff here to talk about private insurance. First, I want to introduce Sarah Summer. She's the Chief Executive Officer of CMA Physician Services. Prior to joining CMA, Sarah was Senior Director for State Policy and Strategy and Associate General Counsel at Blue Shield of California. At Blue Shield, Sarah led strategic projects, including the creation and development of the statewide provider directory, Symphony. Sarah previously served as Deputy Director in the State Exchange Group at the Centers for Medicare and Medicaid Services, or CMS. Sarah holds a JD and MPH from Boston University. Welcome, Sarah. I'd also love to introduce to you Jessie Martin. She's a Chief Strategy Officer for the CMA Physician Services. By the way, that's the California Medical Association. Jessie serves as an advisor to the CEO on strategic direction and planning and helps to coordinate the execution of company initiatives. Prior to joining CMA, Jessie served as a strategic partner for the CEO of 23andMe, healthcare regulatory counsel at a major law firm, and a policy analysis at Cover California. She holds a JD and MPP from UCLA. Welcome, Jessie and Sarah.
Thank you.
Thanks.
You always find that when people read your bio, it sounds way cooler than when you talk about it yourself. We're excited to be we're excited to be here, you guys. This is our second year doing this, so hopefully that means that we did something right the first year. But we want this to be interactive, so please jump in. Private insurance is only as fun and as sexy as we all make it. So jump in, ask questions. If we're going too fast or not clarifying something that doesn't make sense, there's no wrong question. So please, let's make this interactive and fun. Oh, and towards the end of the presentation, we're going to have sort of a what's next in this industry. And we'd really love this to be a really interactive session. We'd love to hear from you guys. We always love to hear your perspective. So without further ado, let's talk about private insurance. So this is our brief agenda. I'm going to give an overview of private insurance, sort of lay the foundation. I think for some of you, pieces of this might be repetitive or things that you already know, but maybe not for all of you. So we want to sort of lay that set foundation so that when Sarah jumps in to talk about what the world looked like before the Affordable Care Act and what the Affordable Care Act was trying to fix and what the Affordable Care Act did fix, it all makes sense. And then at the end, like I said, we're going to do a what's next, and we're really hoping that can be super interactive. So don't be shy. Okay, private insurance. Oh, and then, sorry, I forgot to say this. Kelly already said this, but we work for the California Medical Association. We actually work for a subsidiary under the California Medical Association called the CMA Physician Services Organization. And I know a lot of you are medical students or budding medical students. So if you have any questions around CMA, it's an association in Sacramento. We have almost 50,000 physician members, including students. We would love to talk to you guys about it. So feel free at the end to ask us questions about that too, if you have any. Okay, so health coverage in the United States, these are the buckets that you largely have probably seen the health insurance coverage divided into. I think Kelly said that you guys have already had a primer on Medicaid and Medicare, so maybe this looks a little bit familiar. These are 2018 numbers, so maybe your last presenter had more updated numbers. But generally, this is sort of how the division works. Group insurance is by far the biggest bucket of coverage. That there's about 157 million, or almost 50% of Americans receive coverage in group. I'll go in a little bit into what group actually means, but just keep that in mind. Medicaid and Medicare, which is more on the public insurance side, offered through the government, makes up around 35%. Non-group, which is largely private insurance coverage, is around 6%. And then there's the other major buckets are military, and then there's a slew of reasons, but we have around 10% that are uninsured. So to highlight for private insurance, and what we'll be talking about today are these two big buckets. So not the public insurance side, but the private insurance side. So the group and the non-group. And because we all have a little chart phobia, I like to make multiple infographics so you can see things in different ways. So the private insurance market is around 55% of health coverage in the United States, with around 50% of Americans enrolled in group coverage and around 6% enrolled in non-group and coverage. So what is group coverage? Largely group coverage is employer-sponsored coverage. So if you've ever worked for an employer and they've given you healthcare, That's what group coverage is. But there's also this other category, which includes associations, unions, et cetera. It's a really small percentage. I tried to find an actual percentage, but it's so varied that it's hard to find. But you can kind of think of employer sponsored coverage under group as around like 95+% would be covered under employer. So a lot of people refer to group coverage as employer coverage, but really group coverage would also include unions, associations, et cetera. So employer coverage can be divided into two big buckets: large employer insurance, small employer insurance. There's a variant definitions by state, but for the most part, small employer is around 100 employees or less. Large employer is around 101 employees or more. The other interesting piece around this, and you can kind of zone me out if you're not into regulatory schemes, but the other way that you can think about the employer insurance market is that there's things called self-insured employer market, or fully insured employer market. Fully insured is the health insurance that you know, and I want to say love, but you probably don't love what you know and recognize. It's when an employer will go out, they'll talk to the health plans you've heard of, Aetna, Anthem, Blue Shield. They'll negotiate with them on a healthcare package for their employers, and then the health plan will directly offer the coverage to the different employees. But self-insured is when an employer, largely or typically a really large employer, says, hey, I have so many employees that it doesn't make sense for me to pay a health plan to operate all of this. I want to operate on all of the risks. So what that means is that normally a health plan will have someone come in, they're called actuaries, and they'll calculate out like, how much can I charge for premiums, for the out-of-pocket costs, which are co-pays and co-insurance, which I'll talk about in a minute if you don't know what those are. And they calculate out, like, if someone had a catastrophic health claim, how much do I need to charge everybody or charge this employer for all of their different employees to make sure that I can cover in case there's these catastrophic health claims, right? But if you're a really large employer, why are you paying a health plan to take on that type of risk when you could just do it yourself? It's a lot cheaper. In a lot of ways, it's more efficient. They can offer better health plans to their employees, et cetera. So that's called self-insurance. And they'll actually go to the health plans to do something called TPA, which is third-party administration. So it'll look like to you like you still have a health plan, because you'll have access to the network. They're going to monitor your benefits and they'll manage everything. But the money, the underlying money and the underlying risk is actually with the employer. So I'm not positive, I didn't look this up, but UC Irvine probably has self-insured coverage. And then you guys just have TPA through various different health plans, like maybe Blue Shield or Anthem, et cetera. So really quickly, I'm not going to dive too deep into the non-group coverage, because non-group is essentially another way of saying private insurance coverage. Is when you don't get coverage through an employer, whether it's because you're self-insured or maybe your employer doesn't offer coverage, and you go out and you buy insurance on your own. Not surprising, and Sarah will get into this in a lot more detail, but smaller employers and the non-group or the private insurance market, your negotiating power is very, very small. Like, for instance, in the private market, it's just you going out and talking to a health plan. You pretty much have no ability to negotiate on the premiums, et cetera. So a lot of the areas that were causing a lot of problems before the Affordable Care Act were in these, I don't know if you can see my cursor, but was in the non-group market and in the small employer market. And those are really the big two buckets that the ACA, or some of the really big buckets that the ACA was trying to hit. And Sarah will go into a lot more detail later. I'm going to pause. Are there any questions on this before I move forward? I don't know if oh, there's chats. Maybe.
I haven't seen any questions come in, but Reese and I have our eyes on the chat box for sure.
Okay, cool. Thanks, Kelly. Okay, so let's talk about different types of insurance. I want to caveat this slide. There's no right or wrong answer on what type of insurance coverage you choose. There's just reasons why you might choose one or the other based off of your own health status, et cetera. So you probably have heard of a lot of these, but let's start with the main one, HMO. Sometimes it's called the gatekeeper plan, and that's because an HMO will require that you have a primary care physician. They will require that that you see the primary care physician in order to get a referral when you want to go see a specialist. And so sometimes it's called gatekeeper. But the big thing about HMOs is that they tend to have a smaller network. A lot of times people hear the word narrow network and they go, oh my gosh, it's really terrible. But when you actually think about it, once you have your health plan, you have your established primary care provider, you know what specialists you want to see, you really don't access any of the other physicians on the rest of the network. So why are you paying to have access to this very, very large network? And so that's kind of the theory behind the HMO, is that you don't need this very large network that you're never going to utilize. And because of that, the HMO tends to be the cheapest plan option. On the other side of the spectrum is a PPO, which is a preferred, did I say what HMO stands for? Health Maintenance Organization. On the other end of the spectrum is a PPO, which is a preferred provider organization. They offer a really expansive network, so polar opposite of an HMO, but you're not required to have a PCP, and you don't need to see your PCP in order to, or get a referral from your PCP in order to see a specialist. So not surprising, PPOs tend to be the most expensive insurance plan choice. In between HMOs and PPOs are EPOs, which is exclusive provider organizations. They don't require a PCP. They don't require the referral before you see a specialist. So that's similar to a PPO, but they tend to have a smaller network like an HMO. A POS, which is a point of service plan, is similar to, it's in between an HMO and PPO, but flipped. So they tend to require PCPs. They tend to require that you see your PCP for a referral to the specialist, but they have a more expansive network similar to a PPO. Okay, so finally, HDHPs, which are high deductible health plans. These have really become popularized in the last, I don't know, 5-10 years. So maybe you've heard of them. They don't really fall in this matrix, but I want to talk about them because they're really popular. A high deductible health plan is defined by how big of a deductible it is. And I'll go into deductibles in a minute, but that basically means how much money you have to spend towards your health care before your insurance kicks in. And I'm doing this from memory, but I think a high deductible health plan is around $1,400 for a deductible. I think that's from memory, so don't take my word on that one. So the theory behind a high deductible health plan is that if you don't have a lot of healthcare needs throughout the year, why are you paying really high premiums for potential coverage that you really don't use? And there's a lot of back and forth on this, because if you have catastrophic needs, like if you break your arm, if you end up in the hospital, whatever, you might have to pay a lot of money out of pocket in order to receive the care. So they tend to recommend high deductible health plans for younger, healthier populations that would think of a catastrophic need as a rare and, you know, unexpected occurrence, as opposed to for a population that's a little bit older or has more healthcare needs. High deductible health plans would be catastrophically expensive. So we put down the overall cost in the bottom, but as you can imagine, it really depends on year to year how much you're using in your healthcare or how much insurance you need. So it can be really expensive or really cheap depending on how much you use. Any questions on this before I go forward? Okay, I took this from eHealth because I thought it was really cool. So I'm going to kind of walk through it, but I want to explain, there's something in healthcare called out-of-pocket costs. Really cool people say OOP. I mean, not out loud. We say out-of-pocket costs out loud, but we write OOP. So if you see OOP, it's out-of-pocket costs. Out-of-pocket costs are not premiums, and that's confusing for a lot of people. So when you say overall healthcare costs, so if I go back one slide, you know, these overall costs, I'm talking about premiums, which is the monthly payment for your health plan, but I'm also talking about out-of-pocket costs. And out-of-pocket costs are essentially the deductible that I mentioned before with high deductible health plans, co-insurance, co-pays, et cetera. It's the money that you pay not on a monthly basis, if that makes sense. So quickly, the deductible, I briefly explained it, but a deductible is the amount that you have to pay on a per year basis before your health insurance will kick in and start covering the rest of your care. Co-payments, you probably have heard of, is when you go and see your physician and you're seeing them for, I don't know, your arm hurts or something and you're going to see them and it's a $10 co-payment, and then the insurance will cover the rest of however much that would normally cost. So if it's normally $160, you're paying $10. Co-insurance is a percentage payment as opposed to a flat fee payment. So instead of $10, you're paying 10% of whatever that health exchange was. So if it's, you know, $150, you would pay 10%, you'd pay $15. Out-of-pocket maximum is the amount of money that you have to spend out of pocket through co-pays, co-insurance, deductibles, etc. And it will be a set maximum. And after you hit that maximum, then the insurance will cover all the rest of your healthcare costs for that year. So in this example, what they're saying is, let's say you had a $50,000 medical bill, you went to the hospital, you had a $50,000 medical bill. In your health plan, you had a $1,000 deductible, meaning you have to spend $1,000 before the insurance even kicks in. And then you have a 20% co-insurance, but you have a $6,000 out of pocket. So really quickly, $50,000 medical bill, you pay $1,000 right off the bat because you want your insurance to kick in. And then you're going to pay up to $6,000 to meet your maximum. And so normally you'd pay 20% of the co-insurance of, $49,000 that was left on the medical bill, but only up to $6,000. So the co-insurance here is $5,000 with $1,000 deductible. Total that you've spent that year already is $6,000. The rest will be covered by your health insurance. This is not a hard and fast rule, but generally PPOs have co-insurance, which is percentage payments, and HMOs have co-payments, which are the flat fee payments. Again, not hard and fast rule, but generally that's how it works. Okay, so how do healthcare costs work? It's this slide, I debated on this slide because it looks really crazy complicated, but essentially as your premiums go up, your out-of-pocket costs go down, which makes sense because, right, the health plans are playing this numbers game and they're trying to figure out how much you're going to cost per year for them to cover. And so if you're paying a really high premium payment, so each month you're paying a lot of money to have that health insurance, when you go to the doctor, that amount of money they have to pay is usually lower. And so here's an example. This is I pulled from Covered California. A bronze plan tends to be the least expensive plan. And so hypothetically, you have a $65 least expensive in terms of out-of-pocket costs. So $65 for a primary care visit, as opposed to platinum, which is the most like creme de la creme plan, which is only $15. So if you have a bronze plan with higher out-of-pocket costs, it's not surprising you'll see over here that the premiums for bronze are a lot lower. And then you flip it for platinum. So for platinum plans, which is again like creme de la creme, they have really low out-of-pocket costs. So the premiums tend to be a lot higher. And then I put screenshots over here of the different types of plans so that you could see, like I was explaining before, HMOs, since the overall cost of HMOs tends to be lower, HMOs, whether it's bronze or platinum, is going to be a lower premium cost per year. And then if you move all the way up to, if you're picking like creme de la creme, PPO, platinum, you want really low out-of-pocket costs when you go into the doctor, that's obviously going to be the most expensive. This was a lot of information. Any questions? Making sense? Okay. Stunned you into silence, as I say.
Or you're just doing such a great job in explaining that it makes total sense.
Okay, so who's enrolling in what? We all want to know what everyone else is doing. So this is from 2019. I highlighted that you can see people roll in an array of different types of health plans. And again, like I said, there's no right or wrong answer in what type of health plan you choose. It's really dependent on how much health care you're going to be utilizing throughout the year, and also how risk adverse you are. Like, if you're really scared that you're going to break your arm in the year and you don't want to, or you don't have the funds, and or you don't want to pay a ton of money if something like that happens, like a high deductible health plan probably is not your best option, right? But if you're a little bit more comfortable with risk, maybe a high deductible health plan makes sense. So in 2019, I highlighted here that the majority of people selected a PPO. The second highest was a high deductible health plan, with HMO being around 20%. So just if you're curious, it's always interesting to see also what are the largest health insurers in the country. So Anthem has 10% market share, United Health has almost 10% market share, et cetera. And it kind of goes down from there. I think it's always interesting to me, I guess, to look at this slide and think, wow, we've all heard of Anthem and United, and they don't have nearly as large of a market share individually as you might think. And it's probably because there's a lot of different players. So interesting. CVS is Aetna, just so you guys know.
just on that slide before we get to the ACA stuff, I think what's interesting is the players that I think we hear a lot of buzz about right now. So you hear a lot about Oscar, you hear a lot about Clover, and you hear a lot about like Bright Health as a new one, or all these kind of small startup-y plans that are kind of the underdog plans. They're kind of the like new sexy thing, but they really have a small market share, and they really haven't figured out insurance yet. So just to be totally candid, I think what they've struggled with is they really have tried to fix kind of the technology problem behind healthcare. They have not figured out kind of how to do the rate setting piece, because for all the reasons Jesse mentioned, it's really complicated. So you'll still hear the buzz, but the main players have been the main players, and are doing a lot of interesting partnerships with kind of these new ones to kind of leverage the startups and their technology platform. So I think what was the most recent? Was it Cigna, who has a partnership with Oscar now, Jesse?
Oh, yeah.
Is that right?
Mm-hmm.
Mm-hmm. So I think you'll hear a lot more about those, but I think in context, this is from 2020, and it hasn't really shifted the market in any real meaningful way.
Yeah.
The only other thing I would probably just highlight on this slide, and then we can definitely move forward. The only Blues plan on here is Anthem, but the way that the Blues plans work, which is confusing for most people, is Blue Cross Blue Shield is essentially a brand. So it is a brand that was originally started by Blue Shield of California, actually, and then I think the Blue Cross was out of Massachusetts, but I could be wrong on the Blue Cross. And they came together. They were originally kind of like employer-based insurance. They came together, created a brand, which is Blue Cross Blue Shield. It is now essentially franchised. So you can have, you can only have one of each in any one state, and you have to go to the Blue Cross Blue Shield Association to be licensed. So Blue Cross Blue Shield, if you combined all the Blues plans, they probably have the largest market share by a lot, but they are all separate companies that leverage each other's market across the country. So Anthem is actually the Blues plan in California. They actually are the Blues plan in, I think, 5 or 6 states. HCSC, who is not, HCSC is also a Blues plan. And then most of them are like Blue Cross Blue Shield of Michigan. So I feel like when I used to work for Blue Shield, everyone would be like, oh, I have Blue Shield. I'm like, you probably don't have Blue Shield. You probably have Blue Cross Blue Shield of Kentucky. So that's just something to note on the plan side. All right, moving on to ACA. Pre-Affordable Care Act, otherwise known as the dark days. This was before 2010, when risk selection was bad and risk pools were really bad. And insurers are essentially a business, and their business model is that they need to have more premium dollars come in than the money they spend on care. Otherwise, they won't make any money. And so what they are trying to avoid is avoid risky, high cost, high utilizers, and that's called adverse selection. So if you ended up with a risk pool with a bunch of people who were sick and high utilizers, your premium dollars wouldn't cover it. If you ended up with a bunch of people who never use care, then you'd make a lot in premium. And so the balance is to try and kind of find that. And in the before times, you could actually exclude people who had pre-existing conditions. And this was called pre-X. You hear this a lot. You heard this a lot in the debate around politics. And I think it was used incorrectly often. But essentially the deal is you don't want to be able to exclude people with pre-existing conditions. That means someone like me who has asthma, who was trying to buy health insurance in 2005 on the individual market, would either be excluded entirely from the market, so no one could sell to me, or they could sell to me. They could sell to me at a much higher premium. That goes to kind of the second bullet right there, which is risk-based premium rating. So essentially, you could have different premium bands based on kind of what your pre-existing conditions were or what your risk profile was, and that all of this is called underwriting. So when you look at someone, you decide. And it could include things like your lifestyle choices, such as smoking. It could look at previous like heart disease. It could look at like your family history. You could essentially do whatever you wanted to make up a rate that was specific to a group of people or individual people. And then you could also get at the same problem through your benefit design. So you could say, sure, we're going to cover you at the same rate as everybody else, but the only plan that you're eligible for is this one plan, and what we don't cover asthma medication, or we don't cover diabetes medication, or whatever it is, no maternity benefit.
A common one was no HIV/AIDS medications. Very expensive population for obvious reasons. And so an easy way to not cover that population is don't cover the drugs that they need.
Yeah. So it's a really sneaky way of looking good on the front end, but actually forcing people to buy coverage somewhere else. And then there were no cost sharing limitations. So essentially, there were cost sharing limitations. So they could put annual and lifetime limits on your plan. So you could say like, you're covered for everything, but after $200,000 for the year and $500,000 for your lifetime, we're just not going to pay for anything. And I don't know how many of you have had hospital stays or more likely know someone who's been in a hospital stay, but you could have one, serious illness and be in the hospital for a month, and that is way over it. I mean, we've seen bills of $300,000, $400,000, $1 million. Having a baby in the NICU easily could get you close to those annual and lifetime limits, and then you're completely on the hook after that. And then we talked a little bit about the segment and risk pools, making coverage more affordable for the healthy people and less affordable for the more unhealthy or more risky people is kind of a better way to say it. Next slide. So the major issue is around the risk pool. So essentially, if you are sick, if you have a pre-existing condition and you know you need coverage, you want to go buy coverage. And if you can't get coverage, that's a real problem. So you're generally going to have to pay higher premiums. And what the plans want to avoid is this thing called a death spiral. And that means if their risk pool, so generally, and Jesse explained this really well earlier, but if you have a risk pool, you want it to be mostly healthy. Ideally, you would want it to be all low risk people. That never happens, but like you want one or two, you want to kind of measure the cost and have it manageable. If you end up with a risk pool that is all high cost individuals, that becomes a real problem because your premium dollars aren't going to cover the cost of healthcare. And that means that you have to increase the premium dollars so you can start covering the cost of healthcare. Well, if you increase your premium dollars, that means that the healthy people are going to go to a different plan that has lower premium dollars, and all you're going to be left with is sick people who really need care, are going to pay it because they have to pay it. And then you have more sick people, which leads to you spending more money, which leads to you raising the premium, and then again, excluding any of the kind of middle people, the middle risk people who now go to a different plan. And so the thicker your risk pool becomes, the higher your premiums come, which means the more likely you are to attract more sick people. And that's called a death spiral. And eventually, if you get into a death spiral, you really can't sustain it. And that's how plans end up kind of folding over time. And that's been a big risk for the ACA, but we'll talk about that more later. Next slide. All right. So risk pools and negotiating power. So the general consensus, and this kind of works for everything when you're talking about negotiating, the more people you have, the more kind of market power you have, the better deals you're going to get. And so the people who are going to negotiate the best rates are going to be your large group, your large employers who have a ton of people. So they're bringing, all these premium dollars to the table. They're bringing a giant risk pool so they can manage costs and they can negotiate better rates. So your groups are going to do really well. So you have your groups over here on the left side, you have your employer and other. Under employer, you have your large groups, and then you have your small groups. So your large groups, fantastic, easy to do, negotiate great rates. You can even negotiate as Jesse was talking about, your self-insured. So you can say like, hey, health and plan, we only want you to do the back office function. We want you to pay claims. We want you to contract with the network. We're going to take care of the risk, and therefore we want a cheaper deal. When you're a small group, you have even less bargaining power because you're smaller. So you're bringing 10 to 100 people to the table, maybe even 5. That means that a lot of the health plans are kind of looking at you, and they can actually look at who your employees are. This is pre-ACA, and make some decisions about whether they want to cover you and if they think it's risky, and then again, raise those premiums. So it was very hard for small groups to get health insurance at a reasonable rate. And there was really only one option. It was to go to each plan. There were often brokers. You could go to a broker who would go to each plan and say, and this is off exchange, and say, hey, what's your rate? Here's my group. And you have to fill out all these forms for each plan. They'd review them. They'd underwrite. They'd decide how much they were going to charge you. On the non-group side, you had really like no luck. So, and Jesse mentioned this earlier, but what we're not talking about is Medicare for the elderly, 65 plus, maybe moving down, and then Medi-Cal for the low income. So those, if you were low income or if you were older, you had other options. If you weren't and you didn't have employer sponsored coverage, you could go to each plan or you could go to a broker and ask them to how much they would charge you. And oftentimes you would get those really high rates. So oftentimes health insurance became cost prohibitive. Next plan, or slide. And we'll talk about why, but without the ACA, premiums right now would be 30 to 50% higher. And that's because when you look at in the individual market, that's because when each individual goes, you're looking at a death spiral issue. Because if you, generally who are the individuals who are in an employer sponsored coverage are going to be either folks in a small group who can't afford it, or they're going to, who are generally relatively healthy because they're able to work. Or it's going to be kind of your young and invincibles is what they're called, who are, 20 to 30 who don't have it or they think it's too expensive. And so they're just like, they don't think they're going to have any issues. They don't really worry about it. And so they kind of just don't buy it. So what that leaves in the pool are the people who really need it, who are likely to be more sick or more high risk. Next slide. And then we had the Affordable Care Act. So what we ended up with is the system that was really not working. So we have problems in the United States with a whole bunch of people who didn't have, this is pre-ACA, you had 28 million people who were uninsured, it might have been more, 35 million who were uninsured, and you had challenges with people getting access to healthcare. And what this really meant was that the safety net was picking up a lot of it. So the safety net could be Medi-Cal, which covers the low income. A lot of the hospitals were picking up costs because if you go into a hospital and you don't have insurance and you're using the emergency room as your kind of first line of care, that's going to be a really expensive bill. And who can't afford it? Generally the people who come in without insurance. And they also don't get negotiated rates, so they're being charged the most and have the fewer resources. So eventually we got to kind of a breaking point. Barack Obama was elected president. We had an all-Democratic House and Senate, and they decided to pass the Affordable Care Act. And I'm sure, I'm just checking the chat really quick. I'll answer Joanna's question. What are these costs based on? How do insurers decide what a reasonable premium deductible is for the average individual? So pre-ACA, there was a whole team. There are still whole teams, but there were whole departments called underwriting departments. And if you wanted to buy insurance, you would fill out this I don't know if any of you have parents or family or friends or have filled out kind of life insurance forms, but it was essentially very similar for health insurance. So you filled out this 20-page form about your health history, about where you live, about your habits, everything. You had to put it all on paper. And then you would send it to them, and you would have a whole team who would look at that and be like, this person is a risk score of 7.5. So that's a premium rate of, $800 a month, $1,200 a month. And that's how you got your premium for individuals. And same thing with deductibles and out of pocket. The thing to note with underwriting is that if you filled out that form was going to be what they held you to. And so if you didn't say, so one might think I'm just not going to tell them I have asthma, and then I'll just get a better premium rate. Well, sure, you might, but what was happening and what became so kind of atrocious and egregious was that if you had a different incident, so if you go in for your appendix burst, and so you go in, and while you're at the doctor getting your appendix removed, they ask you your health history. You say, oh, I have asthma. The health insurers would later look at that and say, oh, you lied on your forms, so we're not going to cover anything. Or if you have an asthma attack, they would say, well, you didn't tell us you have asthma, so we're not covering anything. And so it became really problematic because they would start to pick at the littlest of things that you didn't tell them or omit, and kind of negate the whole policy. And make you on the hook for all of those costs. So health insurance was really bad. And then along came the ACA. Did that answer your question, Joanna? I guess the short answer to that is there's a black box of people who, actuaries, underwriters, who make a bunch of decisions and then pop out a premium rate to them.
I think there were crazy stories about too with all the social media becoming popular as they were finding pictures, like people who said they didn't smoke and then they could find pictures of them smoking. And
they'd have whole teams who would, like, because the claims, because of cost, which we haven't really addressed yet, but because of cost, these things, like if you had a visit appendix out, that's a $200,000 claim. And so they would go back through and they would have people essentially like private eyes who would like make sure that you were actually being honest. All right, so the ACA, otherwise known as the Affordable Care Act, otherwise known as Obamacare, despite the Jimmy Kimmel skit where he asked people if they like the ACA versus if they like Obamacare and answered differently, they are in fact the same thing. Yeah. It was passed in March 2010. Was it March 2010?
Yeah,
no,
March 23rd.
It was signed. It was signed on March 2010. It was passed at the end of 2009. The big issue, the reason why it's, I mean, you guys might not get into this, but this is stuff Jesse and I geek out about. So Obama was elected in 2008. They start negotiating it in 2009. It's going back and forth to each house. They had a Democratic majority in both the House and the Senate. And then, dun, 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 in the fall, I mean, in the biggest of ironies, in the fall of 2009, I think it was December of 2009, fall of 2009, Ted Kennedy dies. He dies suddenly of a brain stroke.
Come on, you med students.
We're gonna need some med students here. We do policy. He died suddenly from Massachusetts, was this like great kind of icon of healthcare, had helped with all of the major health reforms previously. Like this was his baby. He dies suddenly. It's super tragic. And then unfortunately, Martha Coakley was the Democratic nominee to take his position, and she lost. And there was a Republican senator from Massachusetts, which tilted the whole thing, which American politics is based on the margins. So what they had to do is they had to pass the ACA through reconciliation. And this is something that you guys are probably all seeing come up right now. There's a lot of talk about reconciliation because generally to pass a bill, you need a majority, of 60. So I guess it's a super majority. You need 60 senators or 61, 2/3 to pass anything that's kind of substantive changes. But if it's a budget bill, then you do it through budget reconciliation and you only need a straight majority, which is 51. And so there are rules, and this actually came up in the American Rescue Act around COVID relief support. It's coming up in infrastructure. What will happen is if you put stuff in the Budget Reconciliation Act, the Senate parliamentarian will look at it and say, sure, that's budget related, it can stay, or no, like what happened with the minimum wage, the national minimum wage that just happened. They said, no, that's not budget related, like that's a substantive change that requires an actual 60 vote majority. And so they were pushing it through reconciliation. And what that meant is they had to move very, very fast. And there wasn't a lot of room for kind of those big changes that they had previously envisioned. Sorry, they had all the big changes, but they couldn't make the minor changes, the cleanup changes. And so anyhow, it got passed, moved really quickly, went into effect. It went into effect in March 2010. Lots of the provisions, the major provisions went into effect in January 2014, but some went into effect right away. So it actually was doing things kind of out of the gate. A lot of the market reforms went into effect right away. It had comprehensive health reform with 3 primary goals. And I'm going to caveat some of this is just going to be my personal opinion, but make coverage more affordable. So I would just qualify there what the ACA did not do, and it was fairly intentional because the third rail of healthcare is always cost. Cost is really hard because in America we have a free market system for the most part, other than Medicare and Medicaid. And addressing cost means you're going to piss off people. So if you're taking money, it's coming from someone, the hospitals, the health plans, the providers, etc. So they made coverage more affordable, but they didn't really address the cost of healthcare. improve access, improve quality of coverage, and support innovation. And so they did this with some of these private market reforms. So what they did is they have a bunch. I mean, the bill itself is 1,000 pages, and the regulations are thousands and thousands of more, but you can no longer exclude people for pre-existing conditions. So you cannot use health status as a criteria for eligibility or aside from tobacco for cost. Guaranteed issue means you have to give healthcare, you have to give a health plan to everyone. So everyone can apply, and you have to issue them a health plan, and you have to renew their health plan. You have to cover these 10 essential health benefits. There's a prohibition on lifetime and annual limits. There's a benefit in summary form that's called the SOB, Summary of Benefits. That's supposed to be more, I will caveat there, you know, we're 10 years post ACA, 11 years post ACA, and healthcare is real complicated. I think even Trump admitted healthcare is complicated. So what the Summary of Benefits was trying to do is to make it easy in a 2 to 4 page document to be able to understand your health plan, because most people really can't. I think what we have found is that it's still very hard to understand your health plan, but it's a good try.
You mean most people don't get a wonderful presentation on private insurance?
Exactly. They don't have Jesse and Sarah to walk them through it. They put limits on out-of-pocket costs, OOP, OOPM is how we talk about it when you're a nerd, out-of-pocket maximum. So there's a set amount for everyone. It varies by individual or family. Next page.
The only caveat.
And then this page is really, this page is talking about how some of them only apply to the small group and individual markets. And that really goes again to like the power imbalance when you're talking about negotiating, because when we talked about it before, the large groups really have been doing fine on their own. It's the small groups and the individuals who haven't been doing as well. Thank you, Reese. I knew it was a brain thing. Reese, this is like real time, like researchers in the background.
Oh, whoa, nice.
The only other thing on that last slide that I just want to highlight, because it has come up a lot, there are lots of market reforms. The three-legged stool that we talk about a lot, and this goes back to the death spiral, and I might be getting to it later, but I'm gonna get to the lead now. The deal is you have to sell coverage to everyone. So everyone is eligible regardless of health status, regardless of pre-existing condition. So the only way to do that is to do two things. You have to make sure that enough people are buying coverage, and that's called guaranteed issue. Have to sell it, guarantee renewability. So that's that second line. The only way to do it is to make sure that everyone buys in. You need enough people in the risk pool so that you can kind of make sure you don't go into a death spiral. And the way that they did that was with the individual mandate. So essentially they were taxing, if you didn't buy health coverage, you got a tax. And then it has to be affordable, because otherwise you're forcing people to buy something that they really can't afford. And so they addressed that with subsidies. And I think if you guys recall, there have been 3 major Supreme Court cases on the ACA. The first 2, the ACA came out ahead. And then the third, is still pending. It's going up for, I think they had oral arguments last spring, and I think, is that right?
Yeah.
It hasn't come out. There's not a verdict, so we'll see. But the second case essentially said that the individual mandate is not a penalty. It turned on the fact that the individual mandate is not a penalty, it's a tax. And so that was made a big difference for that lawsuit. We won't go into the details. Jesse and I are recovering lawyers, so we're not going to submit you guys to that. Why that's important though is when they did the Trump tax bill in 2017, I think it was 2018, they took that tax, and in reconciliation, same as before, they got rid of it. So they kind of got rid of the quote unquote got rid of the individual mandates by taking that tax and moving it to 0. So they couldn't actually remove the tax, but they moved it to 0. So technically, there's a mandate with no penalty. There's no individual mandate. And there was a lot of fear that if there was no mandate, then all the young invincibles, all the healthy people would just leave the market and you would start this death spiral. And what we have found is that that didn't happen as much as we thought. So it definitely happened a little bit. We saw coverage just decrease, I think, I mean, several million, so not nothing by any means, but it didn't completely tank the market.
Yeah, but a big caveat to that is if the bill would have been passed without the individual mandate, the existence of death spiral would probably be, you know, extremely large. And so it's only because the individual mandate was in place for a long enough time, people started to understand the purpose of health insurance, why it was important to get, got used to it, got used to paying for it. And it's probably why we're seeing less of an impact with it being removed as opposed to never imposed.
Yeah, because people are already kind of used to it as the status quo now, buying insurance. I mean, the only other downstream thing I will say, this most recent lawsuit sorry guys, it's a lot of law, but this most recent lawsuit that was filed by the Texas AG and I think 22 other Republican attorney generals, it totally hinged on the fact that now the tax is zero and thus the individual mandate is non-existent. And if there's no individual mandate, then the whole ACA should fall, that it's not severable. So that essentially what they're saying is that the ACA, one of the three major components was that there was an individual mandate, and that if you can't have an individual mandate, then the whole thing should be voided. So we'll see. It sounds kind of like a ludicrous argument to some of us, but then when you start to look into the way the law was formed, and again, how it had to be rushed across the finish line, it's a challenge. I just love that we have the research team on the chat. All right, sorry, moving along. There's lots on this stuff. The ACA, so I actually spent my time at CIO. I'll give you guys my little inside scoop on CIO. So they created HHS, federal HHS, created the Office of Consumer Information and Insurance Oversight, OCIO, in 2010 to implement the ACA. And because they immediately got political pressure and because things changed in the 2010 election, they decided that they wanted to protect OCIO. And so they moved it under the Centers for Medicaid and Medicare Services, CMS, which kind of was an expansion of scope. It was previously just Medicare and Medicaid and Medicare, but it helped protect CIO by making it part of an existing organization. And so now it is CIO, the Centers for Consumer Information and Insurance Oversight, tasked with overseeing the health plans and making sure they're meeting all these market reforms. They're tasked with overseeing the co-ops, many of which failed. Those were kind of a weird public-private plan mix. And then most importantly, not just because I worked on it, is overseeing the implementation and oversight of the marketplaces. And the marketplaces are for individuals and small groups. Again, those groups that don't have the kind of negotiating power and have been historically kind of neglected or left behind or made to base like higher rates, that they have a place to go to buy health insurance. And so there are three options. There are a state-based exchange, which actually was a big compromise to the Republicans. The original ACA only had the federally facilitated exchange, so it was everyone gets on the federal exchange, and every state's individuals can go buy coverage there. And then the Republicans pushed back and said, like, that's way too invasive. We want states' rights. We want state-based exchange. And so that was the compromise. They then did, so what we found really quickly is that there was a need for kind of a hybrid. So originally there was just the federal exchange was a proposed model. The compromise was add the state-based exchange model. There is no partnership model in the ACA, but what we found was that some states really needed some kind of, for the federal government to do some of those activities that were really hard and required kind of large technology platforms. So now there are three types of exchanges: state-based, federally facilitated, and then partnership exchanges, which is that third bullet, which might be the technical term, might now be state-based marketplaces using federal platforms. So we call them partnerships. And what they do is essentially provide, I mean, the goal, and I think Obama said this often, was it should be like an Expedia for health insurance. So a one-stop shop where you can go compare plans, compare benefits, do when Jesse was showing you that premium versus out-of-pocket cost comparison. That's really important. So go to one place, know that it's going to be one pre-vetted by the exchange. So the exchange reviews all of the payers, and then it's going to have all of those benefits guaranteed. And then it's going to allow you to access the subsidies and compare plans. So know what your cost is, and then compare and buy. And that sounds simple. And an Expedia for health insurance, or a Travelocity kayak, sounds fantastic. And I think that was the goal for consumers. I mean, having been there, I would say that the disservice that Obama did by kind of categorizing it as that is that it kind of discounts how incredibly complicated healthcare is and all of the work that has to go on the back end. So that all led, and I'm just teeing it up for kind of the great Obamacare fail of October 1st, which was, there were only 3 years to get this giant platform up and running, to help all of the states get their giant platform up and running. And the platform is, again, more than just like looking at it and picking a plan. That's great. But the platform where the big challenges are is figuring out, like, you as an individual. So me, Sarah Summer, what is my subsidy? So you have to process my eligibility. So I'm actually eligible. Am I eligible for subsidies? How do I prove that I'm not making enough money, or I am making enough money? Because if I qualify for Medicaid, I should go there. And if I have employer coverage offered, I should go there. This is really for people who don't have those offerings and for small groups who need it. So you have to check eligibility, and then you have to kind of calculate the subsidy, and then you have to put all that information in, show what plans you qualify for, and then have people enroll in them. So it's just a lot of legwork behind the scenes. The actual back end is very complicated. And then I would say the other thing that was really challenging for the marketplaces before they opened is that because of the politics of Obamacare, we couldn't get any rules out, because the Supreme Court was, hearing oral arguments, and the states were mad about certain things. And it was just hard to get the regulations passed and to have enough stasis that we could actually start to have the business requirements to build the technology.
I'm sorry, my only caveat to that is, the law passed, but the law tends to be vague in a lot of areas, or have, overarching mandates without specifics. And so what Sarah's talking about is underneath that, which is the regulations, interpret all of those codes that are in the past legislation.
Exactly. Yeah. So essentially the law will say, like, so I think the example of state-based exchange versus federal exchange. So the law says, the ACA says you must have an approved state-based exchange or use a federal exchange. Well, what does approved mean? So that's not clarified anywhere in the law. So that's up to the agency to create regulations that say a state-based exchange can be approved if they do A, B, and C and can demonstrate why. And that's something that would go in regulation. And so you need those regulations to get to the next level of detail to actually create the exchange or the marketplace. Sorry, they used to be called exchanges. Anyhow, there were originally, just giving you my commentary from my time there. There originally, when they started, we had planning grants, $1 million planning grants, and I think 42 of the 50 states decided they wanted to be state-based exchanges. So they took the $1 million and decided they wanted to be state-based exchanges. And then in 2012, the Republican governor circled their wagons and said, you know what, state-based exchanges is actually endorsing Obamacare, and we hate Obamacare, so we're just going to get on that federal exchange. And so we ended up down to 36 who were even considering it, and then that went down to 17 that were actually building it. And of those 17, only 14 made it. The other 4 had, and I'm going to put air quotes around made it, the other 4 ended up as partnership exchanges. And of the 14 that made it, several of them came off of it because it's really hard to do. And so I think there are, I can't remember the numbers now, but I think, New Mexico and Idaho decided recently they wanted to be state-based exchanges, so that went back up. But Oregon came off of it. Massachusetts, who was the original kind of ACA model, came off of it because they were trying to retrofit their marketplace into the requirements of the ACA. It was just really complicated. It is working now. It's working really well now. What the exchange does, you can compare plans, you can apply for subsidies, you can enroll, and then you can pay your premiums. And then regardless of where you live, all plans on the marketplace can only vary in cost based on whether it's single or family coverage, based on your geography, based on your age. So there are age bands. It's not your individual age, there are actual age bands. And then tobacco use. In California, though, you can't charge your premiums based on tobacco use. So it's only the top 3. And it is a single risk pool. So all of the kind of plans risk pools are combined, and then the premiums are approved by the exchange. And some state exchanges have a any willing comer model, which is essentially we will take everyone. And some have an active marketplace, an active purchaser role, which is covered California in California, which means that plans have to apply and commit to doing things to be on the exchange. And that process takes place in the spring. So any questions on health insurance exchanges? Go ahead, Jesse.
And the single risk pool factor is really important. Like we showed on the previous couple slides ago around individuals and their lack of negotiating power, but now they're part of a bigger group, just like a large employer.
Mm-hmm. And so what happens is every year the plans, they put together their rates based on the previous year and they propose them to the exchange. So they have their actuaries who are probably all used to be underwriters, but all their actuaries come together and they say, like, based on last year's experience and based on the risk pool, like we think premiums are going to be X. And then they and every other plan propose their rates to Cover California, and then Cover California approves them or negotiates them and tries to get the best rates that meets the needs of the plan.
Mm-hmm.
And so essentially what the exchanges did is fill that gap for the small and individual, for the small market and for the individual market. So now there is an on-exchange offering. Each plan has to offer, it's called a mirroring requirement. Each plan has to offer the same plans off exchange. So technically, if I wanted to go buy a Kaiser plan, I could go to Kaiser's website and buy that plan. The challenge is I can't get subsidies off exchange. So if I want subsidies, I definitely have to go on exchange. And if I wanted to shop, I would have to go to each plan to check the rate. And so that's why most people use the marketplace, but they legally are required to offer it on both. Oh, perfect. Marketplace type by state. So there are, I don't know what the final numbers are.
This is, by the way, last updated 2020. So there could have been a change.
I think it hasn't changed.
I know.
Yeah, 13 state-based marketplaces, six partnership exchanges, and then 32 on the federally facilitated exchange. All right, next slide. You can see kind of how the politics have played into this, which is really interesting. Essentially, the red states, I mean, it was very coordinated. The red states all made decisions together around being on the federal platform. The blue states pretty much all tried to be state-based exchanges or partnership exchanges. There are a few variations, and this actually needs to change, that one. So there were a few anomalies. Kentucky was the big one. So Kentucky, it was Bashir, it's not Andy because that's his son who is currently governor, but the father Bashir was a Democratic governor in a Republican state in Kentucky. They created an exchange. It was actually one of the highest performing best exchanges. They ended up with a Republican governor in 2016 and he just ditched the exchange. And so now they have a Democratic governor, so we'll see what happens. New Mexico and Idaho are the other ones that are a little bit of anomalies because they're kind of in the purple space. Idaho, I think, swings red. So it's just very interesting to kind of watch the politics and how it plays out when it really, what they have found is the ACA is working for all states. Next slide. The other fear was that you need enough competition on the market to kind of make sure that the premiums are reasonable because otherwise insurers won't go on. And so it was really good news that most states have 3 or more plans, but at least 2 kind of health plans. So most states and geographies. it was really touch and go for the first year. There were a couple, they're called bear counties, that didn't have any applicants. And there was a lot of negotiating with the plans about whether they would cover them. Next slide. Subsidies on the exchange. This is really important. The subsidies are based on percentage of FPL, so your federal poverty level for the year. And your subsidies range from, so if you're Medi-Cal eligible, so 132% of FPL or less, you should be in Medi-Cal. So they kind of divert you and move you to Medi-Cal. If you are not Medi-Cal eligible, up to 400% there are subsidies. And then what we saw was this thing called the subsidy cliff, where you had this incentive. If you made, sorry, I was skipping ahead. Essentially, if you made $1 over the limit of 400% FPL, you didn't get any subsidies and you were kicked off into paying full premiums. And so you would see this like 10% jump if you made an extra $1. So it's creating these kind of weird incentives. And then the other challenge with the subsidies is that the geography is based, the federal poverty levels are based on kind of federal poverty levels. So $40,000, if you're making, you know, $40,000 as a family of 4 in Kentucky or Missouri, you could be doing great. But if you're making $40,000 as a family of 4 living in San Francisco, it might not be the same. And so there are no kind of regionalized geographies for that. And I think that was really challenging in California because the premiums became really high for a lot of these individuals, particularly the like young and healthy who are living in big cities and making enough to almost qualify, but not quite qualify. And so in 2020 or 2019, California expanded subsidies up to 600% of FPL to kind of get rid of that cliff. So they're gradual. There still is a cliff at 600%, but you know, it's small, it's a smaller cliff. And then in the American Rescue Plan Act, this COVID relief bill, the feds decided to do it as well for the next 2 years. And so the subsidies is still an issue. It's still definitely something that needs to be paid for. But right now, for the next 2 years, it's kind of expanded to help more people get health insurance coverage. The other thing that the feds did with the I keep wanting to call it the CARES bill, the American Rescue Plan Act, is that they opened the special enrollment period for longer so that more people can buy health insurance coverage. And the open enrollment period, this will be, I'm almost done, I promise. But the open enrollment period serves the same function as the purpose of the open enrollment period is to avoid the death spirals. And it does that by saying that you can't buy coverage just when you're sick. You have to buy coverage in advance. So you have to be covered, and you can only buy coverage between December 15th, I think, and January 15th. So it's a November 15th?
I think it's November 15th to, I don't know. I actually think I have it written in the later slide.
So anyhow, the open enrollment period is saying that once a year you get the opportunity to buy coverage. Otherwise, you face that tax penalty. Previously, you wouldn't anymore, but you can't buy it later. So you can't decide that like you need knee surgery and so you're going to buy it. You have to buy it in advance. But for COVID, the open enrollment period is still going. It's called the special enrollment period. So we talked about the subsidy cliff.
Should we also talk about my beautiful circle?
How good you are with paint.
Absolutely stunning.
It's gorgeous. And I think we already talked about this, how it created negotiating power for individuals in small groups. So I think we can skip this slide as well. And then again, just re-emphasizing that premiums would be much, much higher and the work that the ACA has done. And this presentation is only on private insurance, but there's a whole nother side to the ACA around Medi-Cal and Medicaid expansion. So I'm sure you guys are going to be covering some of that, but I would just urge you to also look at that, because if you're looking at the totality of the ACA, it's really been instrumental in making sure that people have access to coverage. So Jesse, what's next?
All right. You actually already touched on a fair number of, or a fair bit of this, so I'm not going to go into a lot of detail, but basically we had this era of Trump trying to erode a lot of the provisions in various different ways to ultimately erode the whole bill or law. And now you have Biden coming in with the opposite. He's quickly, one of his first charges in one of his executive orders in January was to get all the federal agencies to review and remove a lot of the Trump barriers that he had imposed through executive orders and various other mechanisms or means. So they're actively doing this review. Sarah already talked about that. The Affordable Care Act is in court. It was brought, led by Texas AG. Like she said, there was a bunch of other AGs that signed on to it, arguing that the ACA's individual mandate is unconstitutional generally, but also since it's been dropped down to zero, the law is not severable. You can't just take out one piece of it, so the whole law should fall. Trump administration supported these AGs in their argument, and now Biden's flipped that and said, actually, the federal government does not support this argument. For the federal exchanges, he moved November 1st to December 15th is normal enrollment period. I knew it was on here somewhere. But he opened up and expanded because of COVID, the exchange open enrollment from expanding it from just ending in December 15th to now being from February through August. That was also through that executive order. So under the Trump administration, they sliced a lot of the marketing dollars. I think I had it written here somewhere. Oh, here it is. They cut $90 million for advertising, and they cut $25 million from what they're called navigators. They're sort of like boots on the ground enrollment help in the exchanges. Biden administration has reinfused that cash, already stating that they're going to put at least $50 million in outreach efforts and $2.3 million additional into financing the navigators. As part of the American Rescue Plan, they are now offering larger federal subsidies. Sarah already went over that to deal with the cliff that we talked about. And then if you've been collecting unemployment, you can sign up for coverage with no premiums through the exchange through 2021. And also normally if you overestimated or underestimated your income for the year and you're getting too high of a subsidy, you normally would have to pay that back to the government when you do your taxes. But they've said for 2020, if you underestimated your income, you do not have to pay it back. And then finally for COBRA, there's subsidies to offset. COBRA is the type of insurance that kicks in if you are no longer employed. You can continue to get that employer sponsored coverage, but you have to pay for everything on your own. And it's called COBRA. And they're now paying 100% of COBRA premiums for individuals who are laid off through September 2021. That was also under the American Rescue Plan. So you can just see there's been this huge shift to like reinvigorating the law, expanding it, offering more and more subsidies, more and more support, especially around COVID and people, losing their jobs and therefore losing their employer sponsored coverage. They don't want them to be shifted into the uninsured market. They want to help them get access to coverage through one way or another. So this is talking about Medicaid. That's outside the scope of our presentation, but I just think it's really interesting. So in that same executive order, that January 28th executive order, the administration said it's the policy of my administration to protect and strengthen Medicaid and the ACA to make high quality healthcare accessible. This is a very nebulous statement, but it's an important statement. It's one of his first statements out the gate is you can tell that there's a lot of push here from the Biden administration to carry on what the Obama administration was had already laid the groundwork for. So I'm not going to go through all of this, but you can look, here's some of the outlines of what the American Rescue Plan did for Medicaid. And interesting. So, well, anyways, they're revoking, Trump administration was permitting work requirements to gain access to Medicaid, which was a lot of, it was a fight between Republicans and Democrats. Democrats were basically saying that was just a way to limit eligibility and knock a lot of people off of Medicaid. Republicans were stating that it's important for those on Medicaid to be working and to prove that out. So the Biden administration revoked the Trump administration's permission for states that had already starting to impose those work requirements in Medicaid, which is a big deal. So the boost in the funding on the subsidies is going to cover this coverage gap, but we didn't really talk about this, so I'm actually going to skip that. So what's next? On the there is an infrastructure plan that I'm sure you've all heard about, and there's discussions that there's going to be a second infrastructure plan that's centered on human infrastructure. So it's expected to include a lot more on health, including making permanent potentially the American Rescue Plan's increased subsidy offering. So, you know, how Sarah talked about with decreasing the cliff, et cetera, they're expecting that might be a permanent thing under the second infrastructure bill. But also when Biden was campaigning, he made a lot of promises around public option as an alternative to private insurance for those that might be ineligible for Medicaid and Medicare. So there's rumors that this could be included in the infrastructure bill or in some other form or mechanism. So anyways, a lot of interesting things to come, a lot going on with this administration already in areas of health. So curious to hear your guys' thoughts. Any questions, any thoughts, any predictions?
So actually, I do have one. So yesterday we had this discussion during one of our sessions around the politics of the ACA specifically, and how it's really difficult based on the makeup of the Senate currently. A 50-50 split does not really allow for a lot of fun policy development because it just can't necessarily get passed. You can squeeze things into budget, but not necessarily a policy. And so this, on this slide, in talking about public option as an alternative to private insurance, is that even politically feasible, knowing what Congress he's working within, and how it's not like a hugely popular policy idea on both sides of the political aisle?
Unlikely. It's unlikely, but well, there's lots of ways depending on how much they prioritize it. So it's unlikely in the just like straight world. Although recently the Senate parliamentarian just released her ruling, I guess, for lack of a better term, on the infrastructure bill, and it was much broader than it was under the CARES bill. So it's possible they could squeeze a lot more into reconciliation that's policy. I think your biggest problem is that it's not like a solid wall of 50-50. Joe Manchin has said like he's not going to vote for things that shouldn't be in there. Kristen Sinema has said she's not going to vote for it. And so if we had like, I just gave away my politics, but if the Democrats had 50-50 that were like a block that was like always going to vote together, it would be possible potentially to either overrule the parliamentarian or put policy into reconciliation. I don't think you're going to see that from Joe Manchin. I don't think you're going to see that from like a lot of the kind of more moderate Democrats. And so I do think it's probably unlikely to get a public option passed with this Senate. And I don't know if that's where they would prioritize their kind of like shifts with those more moderate Dems.
I do want to caveat that in the Affordable Care Act, there was something called, what was it called? Across state plans. You remember this?
A multi-state plan.
Multi-state plans, that's what it's called. And a lot of the discussion around that was like sort of a handout to the Blues because they're, the most represented across all the states. And the idea was to create sort of this like very large risk pool, hypothetically, through these multi-state plans. And so there are other angles where it's not really a public option, as we normally think about it or talk about it, but there's end routes that could lend to larger risk pools, lower costs, doing it from a totally different angle. And I would be curious to see if that's anything that anyone's talking about, but not public option as defined as what we.
Yeah, I would push back on that, Jesse, just because part of the reason why the multi-state plan failed so miserably is no one wanted to apply because it's very hard to sell insurance across state lines. Totally. So the Blues have their kind of negotiated blue plan, which is like you can use each other's network. But the health insurance is regulated at the state level, which most people don't think of. And so you can have your Medicaid or your Medicare, which is like a federal program. And so the public option could be a federal program that works. But if we remember when the Republicans were arguing for this, like, let us sell across state lines, the health plans weren't really for that, because that essentially means you're going to have a plan that has to meet kind of the highest standards of whatever multiple states are in. No, so it sounds nice, but it's hard in theory, or it's hard in actuality.
Yeah.
Another question that I have personally, and I really want to welcome anyone to drop questions in the chat or unmute yourself, but I'm just excited and nerdy about these things. I wonder if you both can comment on how people have either entered, left, or approached the marketplace now that COVID is a thing. A lot more people are pursuing their own insurance plans rather than having them handed to them or a series of options handed to them by their employers. We know pretty well that unemployment has raised significantly, leaving a lot of people to navigate the insurance marketplace on their own. I wonder if you've heard either in your experience through the CMA, from the CMA membership, or just anecdotally through patient experience, how COVID has really influenced people's approach towards the marketplace.
That's a great question. I think there's a lot more people on the marketplace. I also think there's a lot more people in Medicaid or Medi-Cal in California. So I think like if you're unemployed, then you can qualify. And with Medicaid, you can enroll at any point. So whenever you hit that income level. So I do think we're seeing, there's also a lot more uninsured. So I think we're seeing more people on COBRA, which means that you have 6 months to a year. So COBRA, which Jesse was talking about, is the post-employed plan. You pay a premium that the plan would otherwise pay, but you're essentially paying your percentage of premiums and your employer's former employer's percentage of premiums, so it's expensive. So you see an increase in COVID so they can keep care. I think we've seen a lot more people go to the marketplace, and then I think we see people qualifying for Medicaid as well. But to also be frank, a lot of the jobs that were lost during COVID, unfortunately, were from businesses that don't offer health plan benefits often anyways. So a lot of your restaurant workers, your hospitality, kind of the smaller employers are the ones who kind of who are the ones who can't work from home. And a lot of those jobs don't generally offer benefits. So I think most people, I haven't seen like significant shifts into any one type of coverage.
Mm-hmm.
Another thing that I'm hoping you can define for our audience today is what a special enrollment period is. There was a lot of talk in the news about how the Biden-Harris administration offered a special enrollment period outside of what was offered previously. Some people may not necessarily know what that means, because just to piggyback on your point about how people can enroll in Medicaid at any time that they qualify, that might be a helpful definition.
That was actually in the slide that we showed where there was an extended enrollment period that was under a special enrollment period. But basically there's an open enrollment period, which means that no matter your situation, you can enroll in an exchange or marketplace, whatever you want to call it, health plan. But there's, I don't know, 12, 15 special triggers where if there are life circumstances that happen, they trigger, and then basically the equivalent of an open enrollment for you. So if you get married, if you have a baby, if you move into a different geography, things that would basically require you to relook at your health plan for a different reason are things that normally would trigger a special moment for you to enroll. And Biden utilized that as a mechanism to expand the open enrollment period.
Yeah. Generally, special enrollments are supposed to be for life events. So you lose a job, you gain a job, you get married, you have a kid, etc. They're supposed to be for things that are atypical. But I do think they have been used very loosely. There's one that's like extenuating circumstances, essentially, that both the state and the feds have used to kind of create these special enrollment periods. So it's been much broader. I think we were the aim was to have very few special enrollment periods, and I think we've had special enrollment periods almost every year.
I mean, from like a health plan perspective, it's hard to plan your premiums and your cost sharing, like we talked about, your out-of-pocket costs, et cetera. Like make sure that you have, you know, the right amount of money coming in to cover catastrophic health events if people are randomly enrolling at different times. So the goal is to really have set enrollment cycles so that things can be appropriately planned, which is why Sarah's point is good, that, you know, special enrollments really should be limited for the whole system to work. Well, thanks, guys.
Yeah.
Well, thank you both.
Lecture survey is that. Feel free to give us excellent reviews. Jesse and I love gold stars. So
We reach out to people who don't, so no.
As always, Pulse Lecture Survey for feedback is live at pollev.com/AHPE2021. Thank you, Sarah and Jesse, for being here. Y'all managed to make private insurance like actually kind of fun. And
It's our number one goal in life.
And that's why
it
we
is
love
fun.
you all are such awesome contributors to this elective. So thank you for being here. If you're sticking with us for the rest of the day, our next session starts at 2:30, so you have a bit of time. Stick around or not, but thank you, Jesse and Sarah.
Thanks, guys.
Thank you.